Nobody wants a failed retirement. Here's the thing, a failed retirement is not something that happens immediately. It's something that you can see coming. Today, I'm going to give you the number one sign that a retirement is about to crash and burn, as well as what you can do if you find yourself in that situation, and better yet, how to avoid it altogether. Now, I want to start by telling a story of a woman who I used to work with. We're going to call her Jane. That wasn't her real name, but for today's purposes, we're going to call her Jane. This was before I was a financial advisor. I was working at a bank. This was during the dot-com crash, the late 90s, early 2000s, and she had retired in 1999. Now, think back to 1999. The economy had been on a fantastic run. Things were going well. Retirement account balances had ballooned. And at that point, her financial advisor told her she could retire. She was 62 years old, and she did. She retired. She sailed off into the sunset. We had a party for her. There was cake. It was a great time. Here's the thing. We didn't know what was coming at that point. 3 straight years of negative returns in the stock market. You can see here what happened. 3 straight years in a row, the S&P 500 went down. Now, not only was the general market down 3 years in a row, but she was flying high with tech stocks, as a lot of people were back then. And the NASDAQ, which is far more tech heavy, got hit even harder than the overall market did back then. Here's what happened. She was drawing from her portfolio for retirement income. That's to be expected. That's what you put it away for. And as it was going down, the amount that she was taking was no longer sustainable. Now, I'm going to come back to Jane in a minute and let you know how the story ends. But I want to talk about something that I've talked about on the channel here before. That's the risk that we're talking about right now. When you're saving and investing and the market drops, it doesn't hurt you nearly as much if you aren't using the money in your portfolio. If you're growing your portfolio, shouldn't bother you that much. As a matter of fact, honestly, it should make you a little bit happy if you're accumulating assets and the market drops, because you're actually able to buy more for the same dollar. You're buying on sale. Now, I understand that that's not how human nature works. Nobody wants to see the market drop. If you were an investing robot, you'd actually be really happy if the market dropped and you were continuing to save and invest. Although I don't know if robots get happy, so maybe that's a flawed example. Either way, when you have time to recover, a downturn is far less impactful. Might be painful. It's not impactful to your portfolio. When you're drawing from your portfolio, however, it can completely destroy your retirement. I'll give you an example. Let's say that you had $1 million and you were like Jane and you retired and it was the year 2000. And you were going to draw $50,000 a year from your $1 million. That's a 5% distribution. It's a little rich, but it happens. That's what your plan was. And here comes the dot-com bubble, and your account value drops 3 years in a row. Here's the big difference. You're retired now, so you're drawing from the portfolio. So not only is your account value going down, but since you're taking money from the portfolio, it's compounding the issue. It's making things worse. Now, this chart shows you a 60-40 portfolio starting in the year 2000 with the situation I just talked about. Your $1 million that you're drawing $50,000 a year, we're going to adjust it up for inflation 3% per year, and you can see exactly what happens. Without a major change, you're destined to fail right here. Right here, we can see that it's coming, even though it's going to take a while to get here. Only 3 years in, and we can look at it and say it's not sustainable because you needed to draw from the portfolio at a time when it was going down and without either a significant amount of excess assets, meaning you're drawing something like 10 or 15 grand from this $1 million instead of 50,000 a year, or without a retirement income plan that can shield you from needing to sell those volatile assets that are down to pay the bills. You're not going to be able to sustain a distribution rate like that for the next 30 or so years. So at this point, at the end of year 3, you're taking a little more than $53,000 a year, adjusted for inflation now. We've pushed the 50 up. And the portfolio value's down to $705,000. That's an annual distribution of over 7.5%. That's not sustainable. You can't draw that much and live long enough to tell the tale without running out of money. And here's the proof. If we keep following history out, you have positive returns the next 11 out of the 12 years. The market was good, but you'd still run out of money 21 years into retirement. That's well short of the 30 years that the average person is expected to live in retirement. Think about that. Think about a relative of yours who's lived well into their 90s. Maybe it's your mom or your aunt or your uncle. But almost everybody I've ever met knows someone who lived into their 90s. Now imagine living the last 10 plus years of your life completely broke after retiring with $1 million, and you end up broke. It sounds impossible. Here's the thing. It isn't impossible. I'm not trying to scare you, but that's why I have the channel. That's why I do videos like this. This is a risk that almost nobody talks about. They think it's fine. I got $1 million. It's going to work out just fine. Something like this can happen, and it can absolutely wreck a lifetime of savings and mess up your entire retirement. Now, the risk here, as I said, is if you retire into a down market, or if you see a down market early in retirement and you're drawing from the portfolio, it can be incredibly difficult to dig out of the hole because your portfolio's got to make enough not just to recover the losses, but also to cover your distributions. That's a really tough thing to do. Now, let's get back to Jane. What happened to her? Well, essentially, she had three options. These are the three options you'll find yourself with if you end up in a similar situation. Option number one, cut spending drastically. Now, obviously, that's not a good choice, and depending upon how much of that income you need just to exist, to keep the lights on and have something to eat, it might not even be a choice at all. Option number two is stay retired and risk running out of money. Now, in the example I just showed you, that's exactly what would have happened if you lived long enough. Had you lived 21 years in retirement, you're out of money. Option number three, unretire. Go back to work. That's exactly what Jane did. A few years after retiring, she was back at work, saving for the future, trying to gain back her losses, and trading her time, the time that was supposed to be her golden years, for a paycheck again. She had to unretire and go back to work. Now, those are essentially the three options you have if you find yourself in that situation. And so the better question, and as I said, I tell you about this, becomes how do you avoid the situation in the first place? How do you just stay away from this? There are essentially two ways that you can minimize this type of risk in your own retirement. Ideally, I'd like to see people use both ways, but done correctly, either one can pretty much get the job done and help you avoid running out of money potentially or needing to unretire. And so option number one is to create enough guaranteed retirement income for yourself that you don't need to draw from variable assets, from assets that can fluctuate to meet the day-to-day income needs. Social Security, pensions, annuities are the preferred routes here. Build enough of a retirement paycheck to meet the bills so you don't have to draw from assets that can fluctuate. Now, there are other ways. Some people look to only live off of dividends. That's a good income source. It's not a guaranteed income source, and it can also impact the growth of your portfolio if you're drawing all of the dividends off. But if that's your plan, it's pretty tough to run out of money if you're only drawing the dividends, even though your portfolio value will fluctuate. Again, my issue with it is the dividend payouts change all the time. Companies cut dividends, which means a pay cut, sometimes drastically in retirement. They can be a nice supplement for retirement income. Generally, I would not advise using dividends to fund 100% of your retirement income. Again, unless it's such a small percentage of the actual dividends being paid. If you're getting $90,000 a year in dividends paid in and you only need 25, okay. But if that's the case, we probably have to get into the discussion of underliving your retirement resources at that point. I've gone off the rails here. I'm off topic. I did a video about that a while back about using dividends for retirement income. I'll dig it out and I'll link it here in a minute. The second option, the second thing that you can do to minimize this risk is to create a bucket plan. Segment your money and wall off those more volatile growth-oriented assets. Keep them, have them, but keep them separate from your steady income-producing assets and build yourself a buffer. Having those slow, steady assets gives you a buffer to not have to draw from the volatile stuff at a time that you don't want to, even though you need that so that your portfolio can grow. Now, a properly structured three-bucket plan can play a great role in solidifying your portfolio. That's certainly a topic all on its own for its own video, but guess what? I did one about that too, and you can find it right here.